Is it really possible to turn $1,000 into $100,000 in the stock market? A lot of people might say it's just a pipe dream. But what if I told you that with the right strategy, patience, and a bit of discipline, it's not only possible but something that's been done before? In this video, I'm going to break down the exact steps I took to grow my initial $1,000 investment into a six-figure portfolio right here in the US market. We're not talking about get-rich-quick schemes or risky gambles. We're talking about proven, repeatable strategies that anyone can use to build long-term wealth. So, if you're ready to learn how to make your money work for you, stick around. You won't want to miss this. First things first, let's address the elephant in the room. Time. Turning 1,000 into 100,000 doesn't happen overnight. The secret ingredient here is the magic of compound interest. Think of it like a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow, getting bigger and bigger, faster and faster. Your money works the same way. The returns you earn start earning their own returns, and that's when your wealth really starts to accelerate. Let's look at a chart. If you invest $1,000 and get an average annual return of 10%, which is the historical average of the S&P 500, after 30 years, this brings us to our first key strategy: choosing the right investments. When you only have a small amount to start with, you need to focus on growth. This is where growth stocks come in. These are companies that are expected to grow at a much faster rate than the overall market. Think about innovative tech companies or businesses disrupting entire industries. When I started, I dedicated a portion of my $1,000 portfolio to identifying a few of these high-potential companies. The key is to do your homework. I wasn't just throwing money at popular names. I was researching their financial health, their competitive advantage, and their leadership team. For example, finding a company like Nvidia or Tesla in their early days could have provided the massive returns needed to fuel this kind of growth. Of course, individual stocks carry higher risk, which is why you can't put all your eggs in one basket. To balance out the risk of individual stocks, the bulk of my initial investment went into exchange-traded funds, or ETFs. Specifically, I focused on index fund ETFs that track major US market indices like the S&P 500 and the NASDAQ 100. Why? Because it's the simplest way to instantly diversify. By buying a single share of an ETF like VOO, which tracks the S&P 500, you're essentially buying a tiny piece of 500 of the largest companies in America. This spreads your risk out. If one company does poorly, it's balanced out by the other 499. For beginners, this is the safest and most effective way to start. The NASDAQ 100, tracked by ETFs like QQQ, is more tech-heavy and has historically offered higher growth potential, though with a bit more volatility. My strategy was a blend: a core holding in a broad market S&P 500 ETF, supplemented with a position in a NASDAQ 100 ETF to capture that tech-driven growth. Now let's talk about the most crucial part of this entire journey: risk management and consistency. You will see your portfolio go up and down. That's a normal part of investing. The market fluctuates. The key is not to panic. My rule was simple: I never invested money that I couldn't afford to lose. This mindset is critical because it prevents you from making emotional decisions, like selling everything during a market dip. In fact, market dips were my best friend. Instead of selling, I saw them as a discount sale. I made it a habit to add to my positions consistently, a strategy known as dollar-cost averaging. Every month I'd invest a little more, whether the market was up or down. This disciplined approach smoothed out my average purchase price over time and kept me invested for the long haul. Remember, time in the market is far more important than timing the market. Let's walk through a real-world example of how this can play out. Imagine we started this journey 10 years ago, in 2014, with our $1,000. We put $600 into an S&P 500 ETF and $400 into a promising tech growth stock. Let's say that tech stock was a company that performed exceptionally well over the next decade. While the S&P 500 provided steady, reliable growth, turning our $600 into roughly $2,500, the growth stock could have been the real engine. If that $400 investment grew by 50% per year on average, which is extraordinary, but possible with the right pick, it could have exploded in value. But the real key to hitting that $100,000 mark is reinvesting all your dividends and adding new capital whenever possible. Even adding just $100 a month dramatically changes the math. Look at this chart. With consistent contributions and smart investment choices, the snowball effect really takes over in the later years. The first $10,000 is the hardest. So let's bring it all together. How do you turn $1,000 into $100,000? First, you harness the power of compound interest by starting as early as you can and staying invested for the long term. Second, you build a smart portfolio. For me, that meant a core foundation in low-cost index ETFs, like those tracking the S&P 500 and NASDAQ, combined with a smaller, carefully researched selection of high-growth individual stocks. Third, you practice discipline. You manage risk by not investing more than you can afford to lose, and you stay consistent by regularly adding to your investments, especially during market downturns. Don't panic sell. Think of dips as buying opportunities. This isn't a fantasy. It's a roadmap that requires patience, research, and a commitment to your financial future. The journey of 1,000 miles begins with a single step, and your journey to financial freedom can begin with that first $1,000. Thank you so much for watching. I hope this video has shown you that building significant wealth from a small start is achievable with the right mindset and strategy. If you found this content helpful and want to learn more about investing and personal finance, please give this video a thumbs up and hit that subscribe button. Don't forget to ring the notification bell so you won't miss any future videos. If you have any questions or want to share your own investing journey, drop a comment below. I'd love to hear from you. Until next time, happy investing.